Before you scroll away, listen to this carefully, because what I'm about to tell you could be costing you up to £2,000 every single year, quietly, legally, and without any warning. If you are a pensioner, or if you know someone who is, this video might be one of the most important videos you ever watch. Right now, thousands of people across the UK are checking their bank accounts and wondering why their pension money is lower than it should be. And most of them think this is normal. It is not. There is a simple tax code mistake that HMRC is making, and almost nobody explains it clearly. Stay with me until the end of this video, because I'm going to show you exactly how this mistake happens, how it takes your money, and most importantly, how you can fix it and get your money back. Do not skip, because one small detail near the end could save you thousands. And before we go any further, let me say this from the heart. This channel is made for people like you, people who want clear answers, not confusing words, not government language, just the truth explained in a simple way. If you care about your pension, your money, and your future, then this channel is for you and only for you. I regularly upload videos about pensions, HMRC rules, benefits, and money topics that directly affect your life, and I explain them in a way anyone can understand. So please, take 1 second right now, press the subscribe button, because I will keep uploading videos on this exact topic and many more that protect your money. Subscribing means you won't miss important updates that could affect your pension, and it helps this channel reach more people like you. Subscribe now, and let's make sure you never lose money you deserve again. Many pensioners across the UK are losing thousands of pounds every single year without even realizing it, not because they did anything wrong. Not because the rules suddenly changed, but because of a simple and very common tax code mistake made by HMRC. For someone living on a fixed income, losing around £2,000 a year can be the difference between comfort and stress, between paying bills easily or worrying every month. What makes this situation even more frustrating is that this money does not need to be lost at all. In most cases, it can be prevented, corrected, or claimed back, but only if pensioners understand what is really happening behind the scenes. This issue mainly affects people who have started taking money from their private pension, workplace pension, or personal pension, especially when they take a lump sum or their first payment. HMRC's system often assumes the wrong information, and that wrong assumption leads to people being taxed far more than they should be. To understand the problem, it helps to know how tax on pensions normally works in very simple terms. In the UK, most people are allowed to earn a certain amount of money each year before paying any income tax. This is called the personal allowance. For many pensioners, this allowance covers a large part of their pension income. On top of that, when you take money from a defined contribution pension, usually 25% of that amount can be taken tax-free. The remaining 75% is taxable, but it should only be taxed based on your real total income for the year. The problem starts when HMRC does not know how much pension income you will receive over the full year. When this happens, the system often uses what is called an emergency tax code or a month one tax code. This is where everything goes wrong. When an emergency tax code is applied, HMRC does not look at your actual yearly situation. Instead, it treats the payment you receive as if you are going to receive the same amount every month for the rest of the year. For example, imagine a pensioner takes a one-off payment of £10,000 from their pension. HMRC's system may treat that payment as if the person will receive £10,000 every month, meaning £120,000 over the year. Obviously, this pushes the person into a much higher tax bracket, even though that is not their real income at all. Because of this false assumption, HMRC takes far more tax than necessary straight away, and the pensioner receives much less money than they expected. This is how many pensioners suddenly find hundreds or even thousands of pounds missing from their pension payment. They may think this is normal, or that tax rules have changed, or that there is nothing they can do. In reality, it is not normal, and it is not how the tax system is supposed to work. It is simply the result of HMRC using temporary information and applying a default tax code that does not reflect real life. For someone taking regular monthly pension payments, this problem often corrects itself over time as HMRC updates the tax code. But for people taking lump sums or irregular withdrawals, the overpayment can continue for months or even the entire tax year if nothing is done. This is where the figure of around £2,000 a year comes from. Many pensioners are not losing exactly the same amount, but studies and refund data show that overpayments in the range of £1,000 to £3,000 are very common. Some people lose even more. HMRC itself repays tens of millions of pounds every year in overpaid pension tax, which shows just how widespread this problem is. The key issue is that HMRC does not automatically refund this money in most cases. If you do nothing, you may only get the money back much later or not at all, especially if your circumstances change or you do not file a claim. Another reason this mistake is so damaging is that pensioners often budget carefully. They may plan to use a pension lump sum to pay off debts, help family members, fix their home, or simply cover living costs. When a large part of that money disappears due to overtaxation, it can cause real financial stress. Many people assume the pension provider has made the mistake, but in reality, the provider is usually following HMRC instructions. The root of the problem almost always lies with the tax code applied at the time of payment. So how do you fix this problem? And more importantly, how do you stop it from happening again? The first and most important step is awareness. Pensioners need to know that if they take money from their pension and the tax seems unusually high, it is very likely due to an emergency tax code. The second step is understanding that this overpaid tax is not lost forever. In most cases, it can be reclaimed. HMRC has specific forms designed exactly for this situation. Which form you use depends on how you took your pension money. If you took part of your pension and are not planning to take any more that tax year, one form applies. If you took money and plan to take more later, a different form applies. These forms may look confusing at first, but they are actually quite straightforward, and once submitted, HMRC often processes refunds within a few weeks. Another very effective way to reduce the risk of overtaxation is planning how you take money from your pension. Many experts suggest taking a small initial withdrawal first. This small payment allows HMRC to create or update your tax code based on real information. Once the correct tax code is in place, larger withdrawals taken later are usually taxed much more accurately. This simple step can prevent thousands of pounds from being overdeducted in the first place. It is not a loophole or trick. It is simply a way of helping HMRC's system understand your situation before large sums are involved. It is also extremely important for pensioners to regularly check their tax code. Many people do not even know what their tax code is or what it means. Your tax code tells your pension provider how much tax to take. If it is wrong, your payments will be wrong. Checking your tax code can be done online through your personal tax account or by contacting HMRC directly. If something looks incorrect, it can often be corrected before more money is lost. What makes this issue even more serious is that it often affects older people who are less comfortable with online systems, forms, or dealing with government departments. This means many pensioners simply accept the overtaxation and never reclaim what they are owed. Over time, this can add up to many thousands of pounds. Money that could have been used for care, comfort, or peace of mind ends up sitting with HMRC unnecessarily. HMRC has acknowledged this problem and has made some improvements to its systems, but the issue has not disappeared. Emergency tax codes are still used when HMRC does not have enough information, and pension withdrawals are still treated as regular income by default. This means the responsibility often falls on the pensioner to take action. While that may feel unfair, understanding the system gives you power. Once you know what to look for, the problem becomes much easier to manage. It is also worth mentioning that this issue does not only affect wealthy pensioners or people with large pension pots. Even modest pension withdrawals can be overtaxed if the wrong assumptions are applied. Someone living on a relatively small income can still lose a significant percentage of their money in tax temporarily. For those already struggling with rising living costs, energy bills, and food prices, this can be a heavy blow. In simple terms, the HMRC tax code mistake is not about new taxes or penalties. It is about timing and assumptions. HMRC assumes you will earn more than you actually will, so it takes more tax than necessary up front. The fix is to either stop this from happening by making sure the correct tax code is in place, or to reclaim the overpaid tax as soon as possible. Both options require action, but neither is impossible or overly complicated. The most important message for pensioners is this: if your pension payment looks wrong, do not ignore it. If a large chunk of your money disappears in tax, question it. Check your tax code. Contact HMRC if needed. Use the correct refund form if you have overpaid. This is your money, and you have every right to it. Thousands of pensioners reclaim money every year simply because they took the time to understand what was happening and acted on it. In the end, this issue highlights a bigger problem with how complex the tax system can be for ordinary people. Pensioners should not need to be tax experts to receive the money they are entitled to. Until the system becomes simpler and more accurate by default, knowledge remains the best protection. By understanding this HMRC tax code mistake and knowing the fix, pensioners can protect their income, reduce stress, and make sure they are not silently losing thousands of pounds each year. And before we go any further, let me say this from the heart. This channel is made for people like you, people who want clear answers, not confusing words, not government language, just the truth explained in a simple way. If you care about your pension, your money, and your future, then this channel is for you and only for you. I regularly upload videos about pensions, HMRC rules, benefits, and money topics that directly affect your life, and I explain them in a way anyone can understand. So please, take 1 second right now, press the subscribe button, because I will keep uploading videos on this exact topic and many more that protect your money. Subscribing means you won't miss important updates that could affect your pension, and it helps this channel reach more people like you. Subscribe now, and let's make sure you never lose money you deserve again.